Hey everyone, Alex here. Imagine waking up and checking your portfolio and seeing your investments down by 20 or even 30% overnight. Your stomach sinks, panic sets in, and you ask yourself, what should I do now? Today, I'm going to show you exactly what to do, and even more importantly, what not to do when your portfolio crashes. Stick around because later, I'll reveal one counterintuitive move that could turn a stock market crash into one of the best investment opportunities of your life. First off, let's talk about why stock market crashes happen. Markets don't just randomly fall apart, they crash due to very specific reasons. Economic uncertainty, unexpected events, or sudden shifts in investor sentiment can all send stocks tumbling down. But here's something many people don't realize. Market crashes aren't rare. They're actually a normal part of investing. Understanding this helps you avoid panic when the next crash inevitably comes along. But here's the big question you're probably asking right now. If crashes are normal, why do they feel so scary? Great question. The truth is, we're psychologically wired to feel losses far more intensely than gains. When you see your hard-earned money disappearing on the screen, your brain kicks into survival mode and urges you to sell everything immediately. But selling during a crash is often the worst thing you can do, and I'll tell you exactly why in just a minute. Here's the twist. What if I told you that doing nothing could actually be your best move? Sounds crazy, right? But it's true. Historically, investors who stayed calm and didn't panic sell during market downturns ended up far better off than those who tried timing the market. Panic selling locks in your losses and ensures you miss out on the recovery that typically follows a crash. Still, sitting tight isn't always easy, especially if you're new to investing. So, what can you actually do when your portfolio takes a dive? Here's a smart move. Review your investments calmly and objectively. Ask yourself if your original reasons for investing still hold true. Did the company's fundamentals change dramatically overnight? Or is this just a temporary market reaction? If nothing major changed, chances are you're dealing with a temporary dip, not a permanent loss. Now, what about your portfolio allocation? If a crash makes you feel sick to your stomach, it might mean your investments are riskier than your comfort zone allows. This could be the perfect opportunity to rebalance your portfolio, making it more aligned with your risk tolerance. Rebalancing during a crash sounds counterintuitive, but it's actually one of the smartest things you can do to protect your future financial health. But there's one incredibly powerful strategy seasoned investors secretly love: buying stocks during market crashes. I know what you're thinking. Buying more when prices are crashing sounds insane. But here's why it works so well. Market crashes present opportunities to buy high-quality stocks at massive discounts. Essentially, it's like your favorite brands going on a once-in-a-lifetime sale. But before you jump into buying mode, there's something crucial you need to know to ensure you aren't just throwing your money away. You need a clear, methodical approach when picking which stocks to buy during a downturn. So, how exactly do you pick the right stocks to buy when everything seems to be falling apart? In just a moment, I'll reveal a simple checklist every smart investor should follow to confidently buy stocks during a crash. Before we dive into that checklist, let's quickly address a critical mistake many investors make when markets get turbulent: checking your portfolio constantly. I get it, you're worried, but obsessively monitoring every price drop is only going to stress you out and increase the risk of emotional decisions. Sometimes the best way to survive a crash is to step away from your screen. Speaking of emotional decisions, there's another big trap investors fall into during crashes: following the herd. When everyone around you panics, it's tempting to panic too. But remember this, historically, following the crowd has never been a good investment strategy. So, how exactly can you resist the temptation of herd behavior? In a minute, I'll share a psychological trick used by the most successful investors in history that helps them stay calm, rational, and profitable during even the worst market crashes. Trust me, you won't want to miss this. Before I reveal that powerful psychological trick, let's talk about something you must avoid at all costs during market downturns: timing the bottom. Trying to perfectly time when to enter or exit the market is nearly impossible, even for professionals. Guessing wrong could cost you big time, but if timing the market is a bad idea, how do you safely capitalize on market dips? I'll give you a practical and proven alternative to market timing that can help you build significant long-term wealth, even through the chaos of a crash. Curious to find out? Keep watching because what I share next could completely transform how you handle future market downturns. All right, let's dive straight into the practical strategy that beats trying to time the market. It's called dollar cost averaging. Here's how it works. Instead of trying to guess the exact market bottom, you invest fixed amounts of money regularly, regardless of market conditions. This approach automatically means you buy more shares when prices are low and fewer shares when they're high. Over time, this significantly lowers your average cost per share, positioning you perfectly when the market eventually rebounds. But remember earlier, I promised you a powerful psychological trick used by top investors to keep their cool during market crashes? Here it is. Focus on your long-term financial goals rather than daily market movements. When markets are plunging, remind yourself why you're investing in the first place. Maybe you're investing for retirement, your dream home, or financial freedom. Keeping that big picture in mind helps you stay rational and disciplined, even in the most chaotic times. And speaking of rational decisions, here's another crucial move. Use market downturns as a chance to upgrade your investment portfolio. Think about it this way. During a stock market crash, even great companies temporarily drop in price. That means you have a unique chance to buy into top-tier, reliable companies at discounted prices, boosting your long-term returns. Imagine buying companies like Apple, Microsoft, or Amazon during past downturns. Just think of the gains you'd have made by now. But how do you identify which companies are truly top-tier, especially during a crash when panic is everywhere? Here's the simple checklist I promised you earlier. First, always look for companies with strong fundamentals. Check their revenue growth, profitability, and financial health. Do they have a solid track record of weathering economic storms? Second, focus on companies with competitive advantages. Ask yourself, does this company have something unique, a brand, technology, or service that competitors can't easily replicate? Finally, look at their management team. Are the leaders experienced, trustworthy, and capable of navigating challenging market conditions? Now here's an intriguing question. Can a stock market crash actually benefit certain investors? Surprisingly, yes. If you're young or early in your investment journey, market downturns can be fantastic news. You have the advantage of time, meaning you can buy great companies cheaply and hold them as they bounce back and grow substantially over decades. This strategy has helped countless investors build incredible wealth, even though it seems counterintuitive at first. But what if you're closer to retirement? Can you still benefit from downturns? The answer is yes, but it requires careful planning. Diversification and asset allocation become crucial as you near retirement age. It's essential to have a balanced mix of investments, including bonds, stocks, and even cash, so you're less vulnerable to major market swings. A diversified portfolio ensures that even when stocks dip, your entire financial future isn't at risk. Finally, let's talk about mindset. If there's one thing that separates successful investors from everyone else during a crash, it's their mindset. Think of every downturn as a test of your investment discipline and emotional control. Can you resist the urge to panic sell? Can you calmly stick to your plan when everyone else is losing their cool? The reality is, every market crash eventually ends, and markets have historically always bounced back stronger. The decisions you make during downturns will significantly impact your long-term financial success. So, next time the market crashes, remember, stay calm, think rationally, stick to your plan, and don't follow the crowd. Thanks for joining me today, and remember, market crashes aren't the end. They're opportunities in disguise. Stay smart, stay disciplined, and you'll come out stronger on the other side.